Good morning. This is Arlan Suderman, Chief Commodities Economist at StoneX, coming to you on Monday, November 24th, around 9 a.m. from the trading floor. So, I have a couple of things I wanted to update you on today. As we start off this morning, the commodities kind of under pressure, be it the energies, be it the grain and oil seeds. And we're kind of that kind of environment across the board. We're still looking at a VIX, which is Wall Street's fear index, trading at an elevated level of around 22, and that indicates that we still have some concerns there. Stocks are higher this morning on some renewed hopes that we'll get another rate cut from the Federal Reserve when the Federal Open Market Committee meets later this next month. Um, but the grain and oil seeds and the energies, as I said, under pressure once again. And that kind of environment that we're looking at. Now, as we look at what's impacting the markets, we have the trade agreement with China, and that's been central for the commodity markets. To some extent to the energies, but especially the grain and oil seeds, and particularly soybeans. China has been making some purchases. We had another flash announcement this morning of a purchase in another couple of cargoes. That brings what we believe the total purchases to this point with the trade agreement, a little better than 80 million bushels, probably close to 82 million bushels. The 12 million metric tons they were committed to buy by the end of the calendar year would be about 441 million bushels. So they have a little ways to go, but they are making purchases. They've also purchased some wheat and some other things as well. So they do seem to be trying to appease the United States, but there's still some significant questions about whether we will get the fully committed amount. We don't even have a trade deal. When President Trump and President Xi met in South Korea at the end of October, they had a handshake agreement. What the White House announced at that point was the 12 million metric tons of soybeans by the end of the year, 25 million metric tons in each calendar year thereafter for the next 3 years. China has never acknowledged that. The White House said there would be other commodities included in the deal as well, but they were working out the details. Those details would be finished, and we'd have a signed agreement the next week. And here we are several weeks later and still have no agreement. Now, USDA Secretary Rollins said this morning that we should have that deal inked either this week or next. That sounds like what we were told at the end of October, and that we should have more announcements of commodity purchases. But we don't have that. Nonetheless, China is making some purchases, but there are some risks going forward. First of all, I don't know if you've noticed, but the tensions with Japan, between Japan and China, have dramatically escalated. Japan elected a new prime minister who took office in October, and she shocked the world leaders when she announced recently that she was going to stand by Taiwan with military assistance if necessary. Now, of course, that triggered an angry response from China, which quote unquote discouraged its citizens from traveling to Japan, and that's resulted in a sharp reduction in passenger travel to Japan. They also took other steps to reduce trade with Japan as well, and they've been ramping up military activity significantly in the region, particularly between China and the Korean Peninsula, as kind of a show of force against Japan. Now, Japan has refused to back down, and the U.S. ambassador to Japan has publicly expressed full support for Japan, which pulls the United States into it. Furthermore, the U.S. Senate sent a bill to President Trump's desk relaxing restrictions on official engagements with Taiwan that had been in place for 40 years, originally meant to appease China. So the Chinese are now watching very closely to see if President Trump signs that bill or not. That would allow U.S. dignitaries to make regular trips to Taiwan. All of this could blow up the commodity trade deal in process currently with U.S. negotiators, because China is extremely angry if anyone stands up in support of Taiwan independence. Now, President Trump and President Xi of China um, had that deal at the end of October. As I said, we still don't have a signed agreement, so it could all still fall apart. Now, if we look at another factor that could cause it to fall apart as well, and that's what I've been saying all along is the key to any trade deal with China, and that's over rare earth minerals and magnets. That continues to be a sticking point as China continues to find ways for withholding critical rare earths needed not only for manufacturing, but also for our national defense. Europe is fighting the same battle with China now, and China, of course, holds a near monopoly on the supply of rare earth minerals. It's one of the reasons China has been investing in Africa, which holds an estimated 30% of the reserves of these critical minerals. China's been offering zero tariffs to nearly every African country to strengthen its ties with these nations in an effort to build infrastructure within these nations necessary to mine and process these minerals locally, giving it again the capacity to control who receives them. China currently produces 60% of the world's rare earth minerals, while controlling 90% of the supply of processed rare earths. Now, China's unmined reserves of rare earths are estimated to be about 44 million metric tons, or nearly half the world's total. It controls nearly 100% of the heavy rare earth minerals of dysprosium and terbium. I hope I pronounced those correctly. A peace agreement in Ukraine could give U.S. access to its rare earth mineral supply, which is estimated at about 5% of the world reserves, although some of the minerals that it does have are critical to national defense objectives. Yet Russia has continued to undermine any peace efforts in Ukraine ever since President Xi made a trip to Moscow earlier this year. Now, the economy, on a separate note, China is not involved in this, but the economy of Lexington, Nebraska took a hit Friday afternoon when Tyson announced that it would close its beef packing plant there in January, while reducing operations in Amarillo, Texas from 2 shifts down to one. And now the two reductions should take away about 7 to 8% of our U.S. packing capacity, although we should still have enough capacity elsewhere to absorb harvest activity, at least for now. Other plants are expected to take their capacity now from 80% use up to 90% utilization to absorb the cattle not being processed by these two plants. Keep in mind that cattle inventories are a 74-year low. So we were anticipating that there would be some reduction of capacity at some point. And Nebraska has the greatest amount of capacity of any state right now. And so in the plant at Lexington was a converted farm equipment manufacturing plant. So it really wasn't as efficient as many of the other plants. Now, the loss of the plant reduces the competition of all these plants in the region for a limited number of cattle, which had resulted in stronger cash cattle prices. So we'll likely see a softening of the cash cattle trade in the region and maybe higher beef prices as well, modestly so, with the reduced number of suppliers selling the beef to retailers. Now, overall harvest capacity should continue to be there until we reap the benefits of a rebuilt breeding herd several years from now, which is when we could run into some capacity shortfalls. So that's today's update. This is Arlan Suderman, Chief Commodities Economist at StoneX. Be sure to like and subscribe if you want to continue to get these updates from the trading floor.